Well, good evening, everybody. Welcome to our webinar tonight. My name is Shaun from Berg. I head up client education at PSG Online. To get started, let me just throw out two questions. How many of you novices feel that it's a challenge to get started? Okay, I always get this question posed to me, and also I find that many people feel exactly the same way. So the other question is, how many of you would like to know how to select a share as a trader or how to select a company as an investor? So the solution is by having various options available to you and helping in the share selection process or the stock picking process that will enable you to fine-tune a watch list and obviously get to a stage where you have a list of potential winners. So that is my objective today with this webinar. Okay. So the idea with, or the agenda as such is we're going to learn about three things. We're going to work backwards. So first of all, we're going to start with talking about a portfolio of shares and then how to select a share as an investor or company as investor using fundamental criteria, and how to select a portfolio as a trader using technical criteria. Okay, so that's what we're going to discuss in the next few minutes to get started. Okay, so let's move into it. If you go to a financial advisor as a novice investor, the advice most of the time you'll be receiving is to create a diversified portfolio of unit trust and exchange traded products. Okay. Now, I presume that most of you listen to this presentation because you're going to get directly involved in the stock market. But many of novice investors don't have a lot of funds to get started with. And the challenge is if you had to go buy one share, and it's much riskier than buying a ETF. Remember, ETF, exchange traded fund, is through one share you have a basket of shares. Okay, so that's a challenge for most private investors or most novice investors. So the idea is, if you had to obviously buy into one share, the risk is much higher, but also the potential returns is much higher. Now, I'm just showing you since the beginning of this year, Sasol has gone up 20%, over 20%, where Satix 40, which is the oldest ETF listed on the JSE, has gone up 11%. You can see where that potential returns go. But as I say, you're putting all your eggs in one basket, or your one egg in your basket. So the challenge is, or the solution rather, is to add a few shares, individual shares, and build up a share portfolio. And that's why I would say we're working backwards to the stage where you start selecting the criteria for the share. So you build a share portfolio. The idea is that you can maybe put 4 different companies, allocate 10,000 Rand or 10,000 Rand to 4 shares, 2,500 Rand into each. Then your cost as a percentage also is much lower. Okay. So how do we do that? Obviously, we talk about, first of all, we talk about portfolio management, and we talk about the portfolio structure. You can look at what they call the large cap stocks, the top 40 stocks. These are the blue chip shares, been around for a long time, good consistent management, good consistent results. And you can also look at what we call the next 60 companies or the mid-cap size companies. Also good quality companies, obviously they're slightly more riskier than compared to the big blue chip shares. And then anything not in the top 100, we at PSG consider as small cap stocks. And obviously these shares are considered much more riskier because some of them are not so liquid or tradable. Okay, so it's out of these groups of shares that you'll structure your portfolio ultimately. Okay, we also talk about portfolio management and using what we call diversification to manage risk. So we talk about spread of your portfolio. So the idea is to spread it across all the different industries, and I've broken it down to financial, industrial, and resources and mining. And within those different industries, you want to choose between 3 and 5 different sectors, and out of those 3 or 5 different sectors, between 8 and 12 different shares. And that's ultimately what your share portfolio will be consisting of. Okay. So this is just a idea. If you had 100,000 Rand, you can allocate. If I bring in my little cursor here quickly, my spotlight. You allocate 50% of your funds, maybe to 4 large cap companies. Okay, so allocating roughly 12.5% per share. Okay. And then also the idea is diversified along the lines of industry. So these might be a financial share, that might be industrial share, that would be another resource stock, and that might be another industrial company. And allocate 40% of your funds to the mid-cap stocks. In other words, you're allocating 5% to 8 different companies. Okay, so you're allocating less funds to more riskier stocks. Okay, if you add it up, what's missing? We get 50 plus 40, we equal to 90. What's missing is maybe cash. And this is also might be part of your strategy to keep maybe 10% in cash. Why? Because what happens if an opportunity comes along, you fully invested, now you have to sell one of your shares in your portfolio, and you'll be selling for the wrong reason. Okay. Obviously, over the period of time, you'll also be getting dividends, which is the income from the companies paid out in form of dividends, and you can also use that to add to the shares in your portfolio. Okay. But the point I'm trying to make here is the structure of the portfolio and the spread. This is where we ultimately want to get to. Okay. So that's what I meant when I said right in the beginning we're going to work backwards and from there. Okay. So there's two approaches to selecting a share. You use what they call a top-down approach. And according to the Investopedia website, this involves looking at the big picture. Look at the big picture first, and then from there chunking down. So we look at economic analysis, we look at the economy is doing well, and all the things that can affect the economy. Within that within the economy, we look at the best industry, where's the growth as such within that industry, the best sector, and as I say, we just chunk into smaller components. Ultimately, getting to the stage where we're looking at the individual companies. Now, this is ideally, a top-down approach is ideally for a trader, and they'll incorporate this into their trading system. Okay, that's what we call a top-down approach. As an investor, we use what we call a bottom-up approach. So this is where we de-emphasize the economic cycles and the market cycles, and we focus on the individual shares itself. And then from there, we look at everything we need to know about that company. Look at the products and services, but more specifically, its financial statements, and from there, compare it to its sector, and maybe and compare it to its peers. This is what we call a bottom-up approach, and this is more the investor approach. And this is the approach we use at PSG Online, a lot to do with our value investing approach. Okay.